Hey everyone, it's Sean Smith, managing partner at Search Fund Ventures and SMB Investor Network. And I'm here with Grant Hensel, a fellow investor, co-investor of ours. And we're going to talk a little bit about our investment approach, how we got into the space, and what excites us. So Grant, maybe you can kick us off by telling us about your background and how you got started investing in small businesses.
Yeah, I have wanted to be an entrepreneur and also an investor since I was about 12 years old and have always loved entrepreneurship and business ownership and creating value in that way. I began by first demonstrating to myself beyond a reasonable doubt that starting businesses from the ground up is a more painful way to go than acquiring them. I've started businesses 10. Two of them got acquired for small amounts of money. One has actually gone well, which is called Nonprofit Megaphone. We do digital marketing for nonprofits. But the rest of them either fizzled, two of them fizzled out, and the rest just became smoking creators. So learned the hard way that building from the ground up is tricky. And went to Booth, did an MBA at Booth, had a number of friends who did search fund type acquisitions. My wife and I sort of ended up doing a self-funded search where I searched. We acquired a business that she now runs called Lexigate, which does SEO for personal injury attorneys, and was hooked. It's a fantastic model, works far better than starting from the ground up, and have since then been investing in other people doing self-funded search acquisitions, which has been a lot of fun.
Very nice. And you still operate and lead Nonprofit Megaphone, is that right?
Yeah, I'm still the founder. We have a great leadership team who is extremely capable and competent and I could get hit by a truck and Nonprofit Megaphone would be completely fine, but still am involved and helpful wherever I can be.
Yeah, let's hope that doesn't happen. I had a prospective LP the other day ask me what happens if you get hit by a bus, and that's always there's key person clauses for that kind of thing, but you hope that doesn't happen. So it's good that you've set up Nonprofit Megaphone to be able to avoid that, but we'll keep our fingers crossed that you don't need to worry about getting hit by a truck. Cool. Well, why don't you talk to us about what excites you about small business investing versus kind of either buying another one for yourself, or kind of how are you thinking about being an investor now that you've had a few passes as an owner operator?
Yeah, I believe that small businesses, well-run small businesses, are one of the best asset classes that exists. And I've seen that firsthand. And I have a lot of friends who own businesses. They've seen that firsthand. And the one downside of owning a single small business is there is obviously deep concentration that comes from that. And so most of my business owner friends, their most valuable asset is their ownership stake in their own business, which does very well for them. But they're not diversified across industries, across geographies, and investing in people doing small business acquisitions is a great way to diversify. And diversification is the only free lunch that exists in investing, and it is highly valuable. So that is very attractive. I also love working with people and being a advisor or sharing experiences with people who are buying businesses. It is a very rewarding path, but it's also brutally difficult at times, especially emotionally. It's a whole new set of responsibilities and weight on your shoulders. And I have felt that for the last 8 years. I enjoy being able to chat with other people that are going through similar experiences and be supportive to them however I can. So it's a great financial investment, which we can talk about. But for me, it's also personally very meaningful, and I love it and would do it even if there was no financial upside from investing, although that is also significant.
Yeah, that's you're certainly in a unique spot, and there's a lot of folks in the space who have seen success owning and operating a business, and then have kind of switched into the investor seat. But to be able to bring not only kind of the capital to support people, the expertise and kind of an understanding of some of the challenges and how to drive success potentially, since you've done it before, but even beyond that, the empathy that comes with all that stuff, right? And like you said, kind of the emotional capacity to be able to support people and be kind of a shoulder to lean on in challenging times, and be a foot on the gas when people potentially might start to get complacent during exciting times, right? So if you have any stories of kind of how you've kind of thought about that or done that, would love to hear them.
Yeah, I've had the most in-depth experience doing it alongside my wife, which has been actually such a fun experience, but it's been interesting. She is former project leader at Boston Consulting Group, so very high-powered consulting, teams that would charge millions of dollars for like a
Yeah,
month long projects.
for a
So
PowerPoint.
very high intense. Yeah, exactly. Yeah, and helping people make decisions that are like billions of dollars are on the line. So like the $1 million PowerPoint's worth it, but like very intense. 10 p.m. conference calls are the norm. And it's been fun seeing her transition into now owning and operating a business because she has all the raw skills that are needed to do that extremely well. And and we see this with the searchers we invest in as well. A lot of it is just, it's new, it's emotionally different. Like it hits differently to have employees relying on you personally for a paycheck, have clients relying on you, have things that you don't understand, because ultimately being a business owner typically rewards being a generalist and not a specialist. So it's a whole different universe. And it's fun to see all of the ways that basically like self emotional management is actually very impactful for being a successful business owner. So my wife like used to make fun of me for all the things that I would do to sort of manage my own emotions and mindset. Like I would do morning journaling and write down all my wins at the end of each day and set goals for the next day, and like all this stuff. She'd be like, this is ridiculous, like you have all these routines. And now she does all of them, which was hilarious. And she's like, I don't know how I how I didn't live while doing this before. So little things like that are just fun. It's fun to see her. She's incredible. Like she's going to be way more successful than I am, which is great. So it's a lot of fun, and it's fun being able to do that with other searchers as well. We have a guy who's awesome named Haya who bought a home renovation company in Florida, in Jacksonville, AP Advanced Construction. His father was originally a goat herder in rural Ethiopia, actually to a place like in the outskirts of Lalibela, which I've actually been to on a college trip, which is such like a fun random connection. Anyway, long story, like beautiful, like American dream thing. Comes to the US, his dad becomes like a professor or something like that. And anyway, now Haya is buying a business, just like the greatest human being. It is such a joy to be in collaboration and an investor in him and what he does. So it's very personally rewarding, and also just fun to help people, searchers, get through some of the emotional stuff that is what the spreadsheets can never capture, but tends to drive the ultimate outcome that ends up on the spreadsheets one of these days.
Well, you touched on it a lot, but the next question I was going to ask you is, what do you look for in a searcher and a sponsor? And you talk about kind of the generalist versus the specialist. Talk about these habits that really drive, a good lifestyle, but also kind of trickle into the role of leading a business, the attitude, all that stuff. I mean, what's kind of your top 3 or 5 things that you look for and why?
In searchers, the number one thing we look for is this the trustworthy person that we want to be in business with, who has a long-term orientation, who's a person of their word, and who we just want to be associated with from a reputation standpoint. So that non-negotiable. Can't even touch any hint of sketchiness because life is too short and it's not worth it for them or for us. So that's number one. Number two is we deeply value grit and work ethic and just grinding it out. There's no substitute. There are no silver bullets. There's no substitute for aggressive execution. And we really appreciate that. It's one of the things that makes us love self-funded search so much. Is typically a self-funded searcher is either searching at night, often, after maybe their kids have gone to sleep or on the weekends, which is what Hey I was doing, or they're living off of savings, both of which are extremely committed actions to be taking. And that is the type of person that we love supporting and helping go to the next level. That's number two. And then number three, where possible, we like industry experience if it makes sense. It doesn't have to be there, but like, hey, previously worked for an equity fund that managed a lot of single family rentals, including in that area. And so he had a lot of experience hiring and working with the firms that he now bought. Like we just invested in a guy named Sam who bought a manufacturing business, who previously ran actually for a search fund entrepreneur, a similar manufacturing business. And that helps, that is helpful.
So yeah, touching kind of to some degree on at least, it not being the person's first rodeo, having some degree of experience in the sector they're acquiring, or at least some experience leading and managing the team, right? I've heard, a couple schools of thought. There's kind of one end of the spectrum, which is don't need to see a whole lot of experience, really want to see kind of general business acumen, almost like the traditional search kind of, thesis, right? Some general business acumen and an ability to manage and lead, but don't need to be a specialist, and really focus on finding a business that is relatively straightforward to run, and you're not going to need to deal with tons of complexity like capital budgeting and high capex costs and, very unique customer relationships and products, things like that, right? And focus on stuff that's maybe more services oriented, has a higher kind of variable cost structure and all that, right? Versus the other side of the spectrum is let's back a really seasoned, professional operator who maybe is mid-career, has led, 10, 20, $30 million P&Ls or much potentially much larger than that, and go in on a more complex industry because we might have a more unique thesis, and there might be less competition from acquirers in that specific niche. So there's a couple schools of thought there. It sounds like you fall maybe sort of a little closer towards the generalist who is acquiring a moderately straightforward business, but you're not all the way on that side. Is that fair to say?
We're open to both for sure. Yeah. Yeah. I think that is one of the things. All of the checkboxes in my experience are helpful guides, but cannot be the end of the story because there's so many variables. Like typically I wouldn't invest in someone buying a manufacturing business without manufacturing experience, just because it's a tricky industry, but there's always other factors. Like the business that Julia bought has meaningful client concentration, which normally is a complete no-go for us, but the valuation was attractive and there are a lot of other things that were very compelling. So it's fun. I'm interviewing other people that are doing investing in this type of asset class in preparation for writing a book about it. And one of the questions I've been asking is, can you tell me a time where there was an investment decision you had to make that was very tricky? You could have gone really either way and it was hard to tell. And the most common answer to that question is that's every decision, because there's always hair. There's always hair in the market that we're operating in, and that's okay.
Yeah, absolutely. I guess, you mentioned customer concentration as a no-go. Are there any other kind of just absolute no's that you would, cause you to pass on a deal if you see them there?
I really don't like single points of failure. So that would include major customer concentration. One customer leaves and you're dead. Not an attractive investment. Same with supplier concentration. Same with meaningful exposure to some sort of single change. Like if there's one key issue that could change and now you're underwater on your SBA loan, not very attractive. I also do not like, I think that there are plenty of deals out there such that you do not have to go around paying more than 5 times earnings. And so we tend to exclude things above that.
Yeah, we're in a similar boat, especially on that last one. Curious to hear how you think about like key person risk, because it's almost impossible to avoid that. And that's
indeed
can be a single point of failure unless you've set up some type of kind of backlog and recruiting support, or you've got a pipeline of operators. But I think most investors in this space probably don't have that sort of a pipeline with them. So how do you either mitigate that, or how did you get comfortable with it, given it could be a single point of failure sort of situation?
Yeah. So a couple things. One, the nice thing about this type of investing is that typically, yes, you do have a single point of failure in the searcher, and that's the mother of all single points of failure. Mitigating that is the fact that they're signing and personally guaranteeing a typically multi-million-dollar SBA loan for a 10-year term. So the searcher is pretty committed one way or the other. In terms of key employees, it's definitely something that we think a lot about and is very common in businesses of this size. And I think that there are meaningful things that can be done immediately post-close that are part of what all businesses should be doing anyway, of documenting key processes and sort of distributing that knowledge so that it doesn't reside just in one person's head. And the nice thing about this, because I've seen this a lot, and we've had it at various points in our own business, Nonprofit Megaphone, and don't have it anymore, which has been great. But if you have someone who is a single point of failure, it is a very painful existence for them normally, because everyone relies on them. They constantly feel like they're behind. It's very hard for them to take vacation. And so going to that person and saying, let's spread the load. Let's have you be just involved in the most strategic projects and programs and so forth, and not have it such that you have to carry your phone with you constantly 24/7, including while on vacation, is happy for everyone. So that is something that we think is hard to prioritize sometimes, but should be prioritized for everyone's short and long-term happiness.
Yeah, it's a great point. Again, kind of bringing in, I think, a great level of empathy that you probably uniquely have compared to a lot of folks investing in the space, given you've been there. You've been that single point of failure yourself, right? So you know what that's like. And I know you're planning to raise a fund, and if you're going to be a sole GP, sole fund manager, that's may come back around. So how are you thinking? I guess tell us a bit about your fund process and how you're thinking about going that route. And then we'll have a few more questions after that. But we'd love to hear anything you want to share on that front.
Certainly. Yeah. So it's been a fun evolution. I've been investing personally in ETA deals. I've had mentors and advisors who have said, we would like to invest alongside you. And that's been great, of just sending them deal flow. And eventually sort of a consensus emerged that this is a great asset class and the opportunities are phenomenal. However, it is a ton of work. And so I received encouragement to create a fund such that I can do the work on behalf of those folks, which I'm thrilled to do because it's a lot of fun. So yes, we're in the early stages of that. It's going to be called entrepreneurial capital to sort of symbolize the fact that entrepreneurial experience, but then being deployed for this type of investing. And yeah, like early stages, but yeah, we were able to buy entrepreneurialcapital.com for not that much money, which I don't fully understand, but
very nice.
There you go. So yeah, we're excited, and it'll certainly, we will have a meaningful group of either advisors or other participants that'll help mitigate some of that single point of failure risk, because again, something I'm very conscious of.
Yeah, no, that's great. And I mean, as a, professional investor in the space, you kind of have the benefit of being able to create that sort of a capability, right? Having advisors, having, a pipeline of supporting folks that can come in and help out people who, no longer want to be a single point of failure, right? So lots of great resources that you'll be able to bring to the table. Why don't we talk a little about acquisition terms? You mentioned wanting to see deals that are being purchased below a 5 times EBITDA multiple. Are there any other kind of terms around the acquisition, around the deal structure, generally speaking, that you strongly prefer or have an adverse reaction to?
Yeah, there has been great work by Michael at Main Street Capital Network to put together, in conjunction with some of the law firms in the space and other larger investors, a standardized self-funded search term sheet, sort of akin to like the safe note that Y Combinator's put together in angel investing. I think that is a fantastic starting point. And if we always ask for those terms, and that is basically always, no one's ever said no to those terms. They're very fair, they're very reasonable, and it creates a lot of incentive alignment. So the key things are just standard self-funded search distribution waterfall, where investors get the preferred return and capital returned before other distributions happen. Searcher has a salary, which increases with inflation, or 3 to 5% a year, but other than that is capped because you want the searcher to be benefiting mostly from their stock ownership. They'll be the majority owner of the business going forward, so that's their main economic incentive. And then a list of, it's about 10 or so key matters that investors have to vote on. This is things like issuing new stock or selling the business, acquiring new businesses. That just makes sense. And then advisory boards, I think, are a very productive thing for investors to continue to support searchers on post-close.
Yeah, that's great. I think those standardized self-funded search investor terms are so critical. And we actually recently worked on a report with Main Shares where we're going to be putting together and sharing quite a bit of data on. It's about 150 deals or so that were in there. Some had all the data points, others had a smattering of them. But basically, we've got a lot of good information on like what the average step ups were, what the average preferred dividends were, all these terms that are pretty esoteric to the, self-funded search space. But it's good to have that kind of data for folks that are, investing in it, especially folks that are just starting out and kind of getting their feet under them, trying to understand what do these terms even mean. where should they land? I think Michael's standardized term sheet is critical for that sort of thing. And then also, data from reports like we'll be sharing and just that you can get from other investors, frankly, help you get a pulse on the market. Yeah,
Totally.
I agree that because it's still kind of all over the place. You'll see some deals, and I'm curious to get your take on this, but the way we've started thinking about it a bit more is, the investor terms should really be kind of somewhat aligned with how the sources of capital are being structured, right? So if you've got a 2x step up in the self-funded search world, right, that effectively implies, all things equal, that the deal's funded with 50% debt and 50% equity, right? Because if you just stayed, no growth, no margin expansion, nothing, and you just pay down the debt, you get a 2x multiple on the capital that you invested. But what we're seeing is sometimes these deals are, 70, 80% funded with debt, and people are offering a 1.5 times step up, which implies something
which just doesn't work.
Closer to 30, 40% leverage, right? So now investors are kind of taking substantially more financial risk than they're actually being compensated for. So rather than looking at it as every time we want to see a 2 times step up, or every time we want to see a deal structure in this range, it's more important, I think, to look at both things in parallel. Curious if you've kind of had conversations like that, or if you've been thinking about things that way as well.
Absolutely. The guiding light for us, and that we'd encourage searchers that are maybe considering fundraising to think about, is good self-funded search deals pencil at 30% IRR with very conservative growth assumptions. And the best deals can do it without growth, or without growth that exceeds inflation. And so that's sort of the guiding light, because there are a lot of factors that influence the step up. If someone buys a business for a very attractive multiple, that's okay. And if someone and maybe the step up then is lower, that is okay. If they're paying a higher multiple, you typically expect the step up to be higher, because you need that to fairly compensate investors and get to that 30% IRR. And the nice thing is, if you're giving investors a 30% IRR, you as the searcher on your invested capital are still getting like 1,000,000 times IRR, which is good, because you're putting in maybe like 2% of the purchase price and own 70% of the equity or whatever. So it all works out in the end. That is, yes. I don't think people appreciate that yes, a 2 times step up implies, it implies 50% debt to equity. And that almost never happens in self-funded search deals. It'd be more typically, 15% equity, 20% equity. So that is something, if you're not buying very attractively, it may be that the step up needs to be higher to make the IRR in a range that it's attractive for an investor.
Yeah. Yeah, we're seeing more. I guess I'm curious, have you, dipped your toe into kind of the independent sponsor deals at all? And, the structure it's not based on a step up, it's based on a carried interest and probably a slightly lower preferred return, but that's compounding versus simple interest that's expected to be, distributed year over year. Do you do much of that, or are you squarely focused on SBA loan, step up structure, buyer's going to become the CEO?
I've done some independent sponsor investing personally, just because have been really impressed with some of the independent sponsors we've met and felt it appropriate to deploy capital towards them. But yes, it is interesting, because in independent sponsors, you don't get a step up, quote unquote, but you do get the full benefit of the leverage that's being taken on for the business. And then the carry is then deducted from that effectively. And so, yes, we have seen very attractive terms, not always, but in the ones we've invested in, we've seen sort of right down the fairway, normal for the market, and we would consider to be attractive independent sponsor terms. And we think that is valuable for the self-funded search community to just keep in mind, because that is what, in some ways, that's the most direct competition for capital. Like someone like me, I love self-funded search and I deploy there, but if self-funded search did not exist, independent sponsors would be right after that. And if they're having very reasonable and investor-friendly terms, it is going to be difficult for self-funded search to have less investor-friendly terms and still raise money from thoughtful investors
Yep,
in
I think it's
general.
a great
So,
point. I mean, no, it's well said. A lot of folks I talked to have said, frankly, we won't invest in deals unless the fee structure is kind of aligned with the McGuire Woods study, right? That's for
totally.
some people, like we just talked about Michael Trachtenberg's standardized term sheet, but other folks are saying, I only really look at deals that are in line with McGuire Woods, right? And obviously
Yeah.
that's a very different fee model, a very different deal structure. What's interesting is I have seen a handful of deals that have the carried interest independent sponsor type structure, but the top tier of those the top tier of those carries, once they get, call it a 4 or 5 times multiple of
Oh,
invested
yeah.
capital, are like a 80% carry. So all of a sudden now it's kind of like you're back in the step up structure in a way because you're in effect capped at that MOIC. Sure, maybe you get a little
Right.
bit beyond it, but by the time you pass the catch up, it's just it's a lot harder to um, make the claim that you're participating properly in the capital structure as you would be if it was a stepping structure that caps out at 25% carry or 30% carry. So anyway,
Right. Yeah. Well, and that's the reason why we never accept call options, and no one really asks for them anymore. Searchers
hmm.
don't, and if they have a couple of times, we've just said, "I'm sorry, we can't do that," and they're like, "You're right, never mind." They've taken them out. But call options are asking investors to effectively take an equity risk for a capped upside, which just doesn't make sense. You have unlimited downside with equity up to the amount you're investing, and so in my mind, it's not reasonable to say what will give you unlimited downside, but the upside will stop right here.
Yeah, yeah, you start creating something that looks closer to a debt instrument, right?
Right. Yeah.
Awesome. Well, Grant, any parting thoughts? Anything you want to share before we hop off here?
No, we love the space and very much believe that small businesses that are owned by individuals who are personally heavily committed to the success of that business is essential to the fabric of our country and our economy. And so participating in helping the next generation of entrepreneurs run and steward those businesses is such a joy, and we love doing it.
Awesome. Entrepreneurialcapital.com. We'll be looking out for it.
Thanks so much.
All right.